concur with President Xi's view, as conveyed by Vice Premier Liu He, that the policy clampdown is not against the private sector per se, as the private sector economy is critical for employment, innovation, and the future growth of the economy. Rather, the clampdown is against the monopolistic and unfair trade practices which help fuel the rapid expansion of a handful of dominating businesses in China at the expense of the small and medium-sized enterprises and the general public. The clampdown on the internet sector, for instance, also reflects the government intention to focus the country on tech hardware manufacturing, in which China pushes for self-sufficiency to reduce Western influences. Meanwhile, the government-led debt restructuring of Evergrande reflects Beijing's intention to dispel the too-big-to-fail notion and diffuse the systemic risk posed by the high leverage of the property sector. We believe the worst of the regulatory clampdown could have passed, and do not think the debt restructuring of Evergrande poses systemic threat to the Chinese economy. But that said, growth is likely to weaken further as the government maintains its strong grip over the property sector. Our view is to remain constructive on Chinese equities as valuation is reasonable and sentiment is depressed, while reckoning that volatility may persist in the near term. We remain cautious on Chinese bonds, especially on the property names, as the sector is likely to face more pressures. We remain neutral on other Asian markets, as the pros of economy reopening is offset by the cons of peak global trade momentum, Fed tapering, and lingering COVID-19 concern. We remain cautious on Asia FX due to Fed tapering and stay neutral on commodities due to weak Chinese demand.
Allianz Global Investors.